Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
You know, if you're a small business owner, there's one three-letter agency you really don't want getting in touch with you, the IRS. In this explainer, we're going to break down why the risk of that happening is higher than ever, and more importantly, what you can actually do about it. It's time to turn that anxiety into a solid plan.
So have you ever had that little nagging feeling in the back of your head, wondering if a notice from the IRS is on its way? Well, believe me, you are not alone. And right now for entrepreneurs, that question is a bigger deal than it's been in a long time. Let's get into why.
So what's all the fuss about? Well, this number right here, $80 billion. That's the recent budget increase for the IRS. And you better believe a huge chunk of that cash is going straight to hiring more auditors and seriously ramping up enforcement. More resources for them means way more scrutiny for us. Okay, so what does this new reality actually mean for your business on a day-to-day basis? It means that just hoping you'll fly under the radar, that's not a strategy anymore. Your best defense, really your only defense, is to understand exactly what the IRS is looking for so you can build a business that's basically audit-proof from the start. First off, let's just demystify this whole audit thing. At its core, it's really just a verification process. The IRS is checking to make sure the numbers you reported, your income, your deductions, are accurate. It's not an automatic accusation, but certain things you do can definitely move you to the top of their list for that verification. So let's talk about those triggers. What are the red flags that might as well be a big, flashy invitation for the IRS to come take a closer look at your books? Because once you know what they are, you can make darn sure you steer clear of them. All right, the biggest one, the absolute #1 mistake that gets people flagged is messing up your income reporting. You know, whether it's not reporting some cash you took in, having your numbers not match a 1099 someone sent you, or even a simple mistake like reporting your net instead of your gross revenue. These are just the easiest things for the IRS computers to spot. And you might be asking, how do they catch it so easily? Well, it's all automated. It's not some person digging through files. When a client pays you over a certain amount, they send a 1099 form to you and they send a copy to the IRS. Then the IRS computer system just does a simple match. It looks at the expense your client claimed and compares it to the income you reported. If they don't match, boom, that's an instant automatic red flag. Of course, it's not just about income. Other things can get you noticed too, like claiming expenses that are way higher than other businesses in your industry, or being kind of lazy and just lumping a ton of different costs under miscellaneous. Relying almost entirely on 1099 contractors can also look suspicious, like you're trying to dodge payroll taxes. And honestly, just being late with your filings is a really easy way to get on their radar. And listen, this automatic tracking isn't just about tax forms. You've got to be super mindful of large cash transactions. Anytime you deposit or withdraw more than 10 grand in cash in a single day, your bank is required by law to report that to the government. They have to. And a pattern of those transactions will absolutely draw some unwanted attention. Okay, so knowing all the red flags is defense, right? It's about knowing what not to do. But you know what they say, the best defense is a good offense. So let's switch gears and talk about the proactive steps you can take to make your business a much tougher target in the first place. So this is all about building a stronger, more audit-resistant business. And these aren't just little accounting dips. We're talking about fundamental, structural decisions that can make a huge difference in your level of risk. This right here is a big one, probably one of the most important strategic choices you can make, and that's your business structure. Statistically, for years, sole proprietors who file what's called a Schedule C are audited at a much higher rate than corporations. And why is that? It's because that Schedule C directly mixes your business and personal finances all on one form, which just creates way more room for error and, well, scrutiny. So how much of a difference are we really talking about? Well, while the IRS doesn't publish the official numbers, some studies suggest that properly setting up your business as a corporation can lower your audit risk by as much as 15 times compared to being a sole proprietor. I mean, think about that. 15 times. That is a massive drop in risk. So here's the takeaway. If you do operate as a sole proprietor and use a Schedule C, you have to be extra careful about reporting losses year after year. Because if you do, the IRS is going to look at that and start to wonder, hey, is this a real business or is it just a hobby that they're using to write off losses against their other income? You don't want them asking that question. All right, now here is a super simple but incredibly powerful tip.
Trust me on this. It signals to the IRS computers that you're a pro. And that is, avoid reporting your expenses in nice, clean, round numbers. When you claim an expense for exactly $500, it just looks like an estimate. It feels like a guess, not a documented fact. It kind of suggests you might not have the receipts to back it up. But on the other hand, a specific number, like $534.21, that number screams accuracy. It tells a story. It says, I have a receipt for this, down to the penny. And that is exactly the impression you want to give. And finally, you have to make absolutely sure that all of your different tax filings are telling the exact same consistent story. Remember those computers? They will cross-reference everything. The payroll expenses on your income tax return need to perfectly match what's on your payroll tax forms. The total you claim you paid to contractors has to match the sum of all the 1099s you sent out. Everything has to line up. Consistency is absolutely key. So, after we've gone through all these red flags and all these proactive strategies, it really all boils down to one simple core idea. When you strip everything else away, this is what's left. This is the foundation of it all. And here it is. The ultimate takeaway is this: meticulous, accurate, well-documented bookkeeping isn't just good business practice. It is your single best defense. It's your shield. It's your armor. Because with great records, even if you do get selected for an audit, it just becomes a simple, boring process of showing them your work. No panic, no stress. So I'll leave you with this question. If the IRS came asking tomorrow, are your records truly ready to be your shield? Is your business prepared? Thanks for joining us.